the first idea that we can look at, and you can kind of see how the volatility is pricing in much more in the future than right now as far as how it's increasing up. And I don't want to get into, I know we're close to earnings season, and the one thing that I should do real fast just to keep all of us safe, which is always important. So if we look at the calendar, I've already started to update for April, and I haven't built out our events yet, but we can see, Google is on April 27th. So if earnings is April 27th, that explains this pretty large increase in volatility. So if we're going to go into this, well, you don't want to sell, you really don't want to sell an Iron Condor on this expiration, which is why you got to be careful, because that volatility is definitely going to go up at least 50%. I mean, it could go up more. I've seen this stock trade around 40% or 50% IV. If it's at 21 right now, and as we get closer to earnings, it could be smart to buy Vega or buy some volatility out here. That's a little bit more advanced, kind of a separate discussion. But for the simplicity of carrying this idea forward, I say we stick with the regular April options. These are going to expire before earnings. And I think this is a smart trade because we're right around the same level we were at about a month ago. We had a big sell-off. I don't see Google trading down to 820 in the next 2 or 3 weeks. It could, but let's use our probabilities. And again, you can think one thing, but it doesn't mean a whole lot if you can't confirm that with some type of mathematical, continuity, whether you're using probabilities or theoretical, or what we use, the probably out of the money, just for framework. So if we take the 825 puts, 75% probability expiring out of the money, and I'm going to just start building this out real fast. So we're going to sell an Iron Condor, and we're going to change the call side up to 875, 880. And this is personal preference. Like some of my trader friends that trade a large quantity, they like to do really tight spreads. And I say, what about commissions? That really ties up a lot. You definitely pay a lot more commissions when you have to do more contracts because your spreads are smaller. I think as a default, a $5 wide spread is totally fine here. You definitely could do an 875, 885 if you wanted to make it a little wider. And we'll look at that here in a minute. But the starting point is just to build out the framework of this trade. And from what I'm seeing right now, I really like this starting point because we're at a 75% probability. These are the puts. So 870, 825, I'm just making sure my strikes are all right. So we're selling the 825 put, buying the 825. And then on the call side over here on the left, we're selling the 875s, very close to the same probability that it'll expire out of the money. So there's not as much emotion involved here. Really, there's hardly any. I mean, you can have a directional bias and you can use the charts and all that different things that we talk about. But with this trade, we're using more of a non-technical, non-emotion, more of a mathematical, more of a probability decision-making standpoint. So if we're selling a 75% probability of expiring out of the money spread, and we can receive a $2.15 credit on a one lot, you can see right here, where max loss is 285, and we can make 215. So there's a 75% chance that this trade will be successful and both these sides will expire worthless. A lot of times we're going to buy this back for like 30 or 50 cents, a week before expiration, just to remove the margin and reallocate the capital. But I like this 225. I'm going to get two of these working while we're talking about it. So this is risking 550 to make 450. And I just want to show you what we got here. So it's holding 225. It hasn't filled yet. I'm just starting with 2 contracts. If I create a duplicate order, I don't have a problem doing like 5 of these. So if I have to come off mid-price, this is always how I do it when I'm testing. You always want to test with a one lot. And you can kind of see that 220 is not filling. So the mark is 225. And we're selling this Iron Condor 4 different strikes, which is kind of a cumbersome trade. It's definitely not as easy to fill an Iron Condor as it is to buy a call or sell a put or something. But this definitely shows you the process of, being patient, number one, and number two, testing the market. So if we're coming off a nickel off mid price, you can see the mid price is now 230. It's not filling at 225. It's not filling at 220. The question you have to ask yourself is, are you okay with a $2.15 credit if you can get filled? And for me, I'll come down to $2. I'm totally fine risking $300 to make $200 on this spread. And we can see it just changed to 220. So I'm going to try 215. And sometimes you have to let these sit. I'd love to get filled on this, but this is part of the process of being patient and just letting things work. I'll try one more at 210. And still point out these are not filling yet. So we've changed the mid prices coming down now to 215, 220. I'm going to try these two at 210. So 225 was a little aggressive. 210 is still a great fill, I feel. So again, max loss is 5.8, and this is a very attractive risk profile. When you're risking, $600 to make $400, and you have a 75% probability of success. And these are the type of income trades that you want to have interlaced with alongside our longer term ones, I feel.